Welcome back. My name is Chris Gosselin. Today we're talking to Phil Sciacca from ASCF, Australian Secure Capital Fund. Phil, welcome. Tell me a bit about the sector and the property sector and your view of it at the current time.
Sure. So we've obviously had some significant growth over the last 12 to 18 months coming out of COVID, Chris. So we don't believe that level of growth is obviously sustainable, and we think things will be flat moving forward for some time, particularly in Sydney, to also Melbourne, and to a lesser extent in Brisbane. I note some economists are saying that they expect the market to actually come off sort of 6, 8, 10% over the next sort of 12 to 18 months. We don't actually see that happening. We see it being flat, certainly across the eastern seaboard states, with the exception of Brisbane. We think that as the borders open up and you start to see that overseas migration come back, we think that'll soften the blow in terms of anything coming off the boil in terms of property. We think there's considerable demand in terms of overseas investment in Australia, particularly based on the fact the way the country's handled COVID so well. So we see it being flat, but we do see that there is some potential upside in Brisbane, particularly with the Olympics in the not so distant future, and the infrastructure spend in Brisbane. So we think Brisbane could continue to see some level of growth, particularly in view of the price disparity in residential housing between Brisbane and the other states, particularly Sydney. But certainly rates are going up, and at the same time, though, we think that there's going to be some wages growth, which is certainly going to cushion that in terms of people being able to afford to continue to pay their mortgages. So whilst we don't see any sort of significant growth over the next sort of 18 months or so, we don't think that it's going to come off in terms of the way that some economists are predicting. We think it will be flat for a while, and we think that overseas migration will certainly add some impetus to the market as the borders continue to open up and we start to see those migrants coming back into the country.
And how affected are you by what happens in that market? I mean, you're talking about lending on a short-term bridging finance less than a year. So is that really going to affect you if the market does come off?
No, and that's one of the benefits of investing with ASCF is, we're not out there doing 5, 10, 20-year loans. We're very much in the short-dated space. Sort of the average loan term, as I've said, is sort of 6 to 9 months, and the maximum loan term we'll do is 2 years. So in terms of market sort of movement during that period of time, it's pretty limited in terms of what the market can come off over a 6 to 9 month sort of time frame. I mean, the maximum we lend on any given property is, the maximum we're allowed to go to is 80%, and certainly if you look at the average weighted LVRs across our funds, that they're always sitting sort of around that 60-65% maximum, and in many cases they're lower. We provide those data sets to our investors on a monthly basis so that they can see exactly where those average weighted LVRs are. We also provide a loan summary to our investors, which they can download off our website, which shows every single loan we do, and the location and the rate charged and the term of the loan. So we're very transparent with our investors in terms of where their money is being placed in mortgages, and I think that's important that they do know, and they can, if they've got any queries, they can certainly email us or ask the question.
So you're relatively buffered from any sort of short-term or even longer-term vagaries of the market or volatility within the property market?
I think we are, just because of the fact that we're only in that short-term space. So market movement in a short period of time, what can it move? 3-5% over that time. If your average weighted LVRs across your funds are sort of sitting at around 60-65%, that sort of movement's really not going to impact us. As I've mentioned, we don't do any construction lending or anything along those lines, so we're not impacted in terms of pre-sale sticking at the end of the day when the building's complete, or any of those sort of construction risks associated with those loans. So So we're very vanilla. We're really a stopgap for a lot of borrowers, and it's really because of the inefficiencies and in the banks that we have the ability to move a lot quicker than what the banks are, assess loans quicker, and I think we're very transparent in terms of our fees and charges to borrowers, and I think the way we operate in relation to maintaining a decent net interest margin between what we pay our investors and what we lend funds at sort of gives our investors a lot of comfort in terms of knowing that there is a buffer there that sort of cushions our ability to pay their interest on a monthly basis in the event of you get another COVID or any of those sort of macro events. That there's a nice cushion there to buffer anything like that, and certainly we hold a 1% reserve across our funds in the event of any potential losses. So I think in terms of the risk profile of the fund and the way we manage the money and where it's lent, I think we're very transparent, and the business model we operate in has held us in good stead. Certainly in terms of the investment profiles that our investors can invest in across the three funds, we have 3, 6 and 12-month terms, and we also have a new fund, Premium Capital, that we launched about a year and a half ago that does offer 24-month sort of terms for investors. But certainly the investment terms do match the loan terms. So that's very important in our space. The last thing you want to be doing is getting investors to invest in 1-year investment terms and then go off and do 5-year loans with it. Well, it's a complete mismatch, and certainly that's an important part of what we do, ensuring that there's always ample liquidity there in the event that you have redemption requests or some macro event that sort of requires investors to redeem their funds.
And Phil, your source of funds, is it entirely coming from private investors, or do you have a line of credit from a larger institution?
Sure. So across the group, the majority of our funds are from retail investors. So that might be SMSF funds investing with us, or on one scale, and on the other scale you've got people saving for a deposit or looking for a better return than what the banks are able to offer them. So it's a broad spectrum in terms of our investors, but yeah, the average investment is sort of around 100 to 125,000, but the minimum is sort of 10 grand, and there is no maximum. We've got investors with significantly more than that.
And your investors, what they're obviously looking for is a better return than they're getting from the bank, but with some level of security. I mean, it's obviously not bank backed, but it's mortgage backed. So a much higher return than the investor would get in the bank without locking it away for a long time, with relatively good security being mortgage backed.
Exactly right. So our funds are not government guaranteed, and the investment's certainly not government guaranteed, but it's guaranteed by the mortgages that we take over property in Australia. So it's very similar, I guess, to what the banks do in terms of their security position. But so it's all backed by mortgages in Australia, predominantly over residential property in metro areas. We don't do any specialised lending of any sort. There is a commercial component to the book, but it's only a very small component. It'd probably be less than sort of 5 to 7%. So very much so, the book is entirely backed by mortgages over Australian property. There's no lending across any of the books. We don't borrow additional money other than what the investors provide us. All the funds are held by an independent custodian, and the funds are audited every 6 months.
So, Phil, just looking back over the 5 years, has there been any significant delinquency on the loan side, or do you have an average of delinquencies, or do you have any delinquencies at all?
So it depends how you define delinquencies. Certainly, there's arrears that come up from time to time across the funds, but we certainly manage those arrears. If someone comes to you for a 4-month loan on a bridging product, and you capitalise the interest for the 4 months, and then they need an extra month or two to exit, we certainly work with them, and maybe we carry that interest for that month or two. But because it's very short dated, If it's a month or two, we'll certainly work with them. But in terms of losses, if that's what you're referring to, Chris, we've probably funded in excess of $650 million since inception, and in terms of losses across that entire funding spectrum, I think the principal losses have equated to sort of just over $1 million in terms of principal, and certainly with the net interest margin we run at and the investor reserve, we were able to comfortably cover that without any impact on investor returns or unit price.
It's always difficult to talk about risk, and it's always dangerous to talk about negligible risk. But in actual fact, the history of the fund is that you haven't had delinquencies that have affected your investors.
Correct. Yes. So no impairment that has occurred, and in terms of impairment, I'm talking about principal impairments. So I can tell you now, I think it sits at around $1.2 million. Across over sort of $650 million in loans funded, and certainly that level of impairment did not impact any of our investor sort of funds, unit pricing, or our ability to pay their monthly return on time.
And how large is your investor base, Phil, as in number of investors and concentration of investors? You mentioned that the average was 100 or 125,000, and that it could go down to 10,000. But do you have a concentration, or is that ensuring that you don't have a concentration of investors?
No, so we have over 1,200 investors, Chris, and that's growing on a monthly basis. So the average is around that 100, 120,000. So there's no significant concentration in terms of investors. We do have some investors which obviously have, several $1 million with us, but they've built that up over time, and we've certainly earned their trust to be able to sort of leverage that sort of investment from them. But we've got a very good reputation in the marketplace with our investors. We haven't missed a beat, and we think that we continue to be able to grow the book in a manner that we're comfortable with, and ensure that we're very risk adverse in terms of how we do that.
So I guess from the investor's perspective, the fact that you're giving a regular return, monthly income, it's been very consistent, and there's no volatility and no downside, or there has been historically no downside, is what's attracting investors.
Absolutely. I think the track record and the fact that we're very transparent in terms of, all of our audited financials since inception across all of our funds are on our website. In terms of every loan we fund, they can see exactly every loan we funded on our website since inception, and they can see exactly which loans are being repaid, which ones haven't, the new loans we've drawn for the month, the locations they're in, which fund has funded them, the interest rate we've charged the borrower, and the LVR on the loan. I think that level of transparency is something that I can't think of any other funds that do that in our space, and I think our investors appreciate that, and it certainly enables us to gain their trust in terms of being able to manage their money and provide them with a decent return.
Phil, it's terrific to talk to you. I think trust is one of the most important things in investing, whether it's equities or whatever it may be. So best of luck with the fund. We hope it continues to grow. I'm sure it will, and give your investors a good return. Thank you for your time today.
Thanks very much, Chris.